Hello, everyone. Welcome to Strictly Money at the News Forum, where all voices matter. I'm Saijal Patel. The COVID pandemic, inflationary pressures, and supply disruptions continue to be the big what-ifs, and it's made it difficult for many investment strategists to predict how the stock markets will fare in 2022. My guest on today's show believes that there are some parallels to what we're seeing now compared to what we saw in 2014 that should give us some clues as to where the markets are headed and how investors should position their portfolio. Dennis Mitchell is CEO and Chief Investment Officer at Starlight Capital, and he joins me now. Dennis, it's great to have you on.
Well, thanks, Saijal. Great to see you.
So it seems on the surface that the markets have been pretty resilient. I mean, despite inflation, despite the pandemic and supply issues, should we expect more of the same of what we saw in 2021, or do you think the shoe's about to drop?
Well, I would love if we saw more of the same from 2021, as equity markets delivered fantastic returns, and I have to think clients were pleased. Unfortunately, that's not likely to be the case. If we look at 2021, it was really driven by a massive rebound in corporate earnings. And so earnings per share have historically grown at about 6% per year. Last year, they grew at about 21%. And so most, if not all, of the return that you saw was earnings per share recovering and stocks responding to that. Now that we're past sort of the pandemic bounce, what we're seeing now is that returns and earnings per share are going to decline, at least the growth rate. And so the return that you can expect out of equities as a result are going to moderate. And specifically, the Fed is beginning to taper its bond purchases. The long end of the yield curve is starting to respond to that. And really what we expect to see in 2022 is much of what we saw in 2014, the last time the Federal Reserve tapered bond purchases.
Yeah, so let's go through that, because I read your report and you did say that there are similar conditions to what we saw in 2014. So can you walk us through some of the parallels and then also what's different this time?
Sure. And so if you recall, in May of 2013, when the FOMC, the Federal Open Market Committee, first began talking about tapering bond purchases, they really caught the market by surprise. And so as a result, we had the infamous taper tantrum, where 10-year bond yields spiked over 100 basis points in response, and equity markets got very, very volatile to the downside. Once the market had digested that information and the FOMC actually began tapering bond purchases in January of 2014, what we saw was that long bond yields continued to march down over that time period as they tapered from January to October in 2014. And while equity markets delivered positive returns, global equities delivered about a 5% total return. Fortunately for investors like myself, real assets significantly outperformed. And I think investors would have been surprised to see that while U.S. equities delivered an 11% return in 2014, U.S. REITs delivered a 25% total return. And that is really a function of the impact of sort of stable long bond yields or declining long bond yields versus rising costs for traditional businesses. And we're likely to see that play out even more so in 2022.
Dennis, can you explain the yield curve? Because it is a signal of where future rates are headed. It's a sign of how people read the economic activity. What are you seeing sort of on the short end and the long end?
Right. And that's a great and important distinction, Saijal.
Yeah.
I think a lot of commentators always talk about rates are going up or rates are doing this, but they never really speak to, is it policy rates? And those are the rates that the Bank of Canada or the Federal Reserve set, and they tend to be on the shorter end of the curve. Or is it long bond yields that are more driven by market factors like expected growth and expected inflation? And the two can actually move in opposite directions depending on what's happening in the economic environment. So these days, when people are talking about rates, they're often talking about policy rates, the short end of the yield curve. And that is definitely headed up. In fact, I think a lot of your viewers will be surprised to know that there were over 50 policy rate hikes last year alone.
Wow.
So while everyone is focusing on the Bank of Canada or the ECB or the Federal Reserve in the United States, central banks around the globe have already started the tightening cycle, and the cost of money has already gone up and financial conditions have already tightened. Now, what that does is it reduces your expectations for growth going forward and inflation going forward, because central banks only tighten interest rates or raise interest rates when they think that future growth or future inflation is too much. Okay. And so they want to cool the economy. They want to bring future inflation down. And as a result of the expectations for future growth and inflation coming down, what you often see is long bond yields come down.
Welcome back. I'm here with Dennis Mitchell of Starlight Capital. Dennis, before the break, we were talking about the yield curve, short end and long end, and economic forecasts. We know that there is two levers to manage the economic growth, right? One is the fiscal policy, and the other one is monetary policy. How would you rate how both are being managed here in Canada?
Right. And so when you're looking at monetary and fiscal policy, it's important to understand what they are and what their objectives are. And monetary policy really comes down to the cost of money, right? So if you want more businesses to hire people and to invest in productive capital, then you lower the cost of money and you increase the cost of money to do the opposite. Fiscal policy is really about incentives, i.e., so if I want investors to take on more risk, then I do things like lower the tax rate on capital gains compared to, say, interest rates on interest income. So those are really checks. Those are really how monetary and fiscal policy work. Now, looking at the pandemic, the challenge that Canada had, the federal government and the Bank of Canada had, was we needed to somehow shut down the economy in a controlled manner and still replace the income of households and the revenues of corporations. And so fiscal policy took care of the latter in terms of replacing the income of households and the revenue of corporations. And then monetary policy was already extremely accommodative. All we really did there was increase liquidity such that those businesses that were still operating didn't have to worry about making payroll or being able to refinance bonds or what have you. So I would actually give both the Bank of Canada, the Federal Reserve, and if we extend it out, the federal governments in each country, I'd give them an A+ for how they managed both monetary and fiscal policy during the pandemic. And I'm sure that a lot of people will push back and say they could have done this better, they could have done that. The measure is not how far away from perfection they were. The measure is our economy didn't, plunge over the abyss and plunge us into a long depression. So based on that measuring stick and the more recent comparison to the financial crisis that we experienced in 08 and 09, I would give them solid A+ for their performance.
Do you think, we've heard, based on what we saw, inflation come in the U.S., 7%, a 39-year high, and now it's expected that the Feds might raise rates 4 times this year. I'm wondering, does the Bank of Canada pretty much have to follow in lockstep to what happens in the U.S., or do we have leeway? And could this cause any sort of policy mistake? Because I think that's what the market seems to be worried about.
Right. And so it's very difficult for the Bank of Canada to act it's very difficult for the Bank of Canada to stray far away from what the Federal Reserve does because our economies are so intertwined. Yeah. There's the old saying in the past, when the U.S. economy sneezes, the Canadian economy gets the flu. So I would say that the Bank of Canada is going to, and in this case needs to, increase rates at a similar pace and a similar manner as the Federal Reserve. Now, keep in mind, part of that is because we're both starting from zero, right? So historically, when you're fighting a recession, the central banks cut interest rates anywhere from 200 to 300 basis points. If you're starting at zero, there's no traditional and conventional ammunition. So you need to hike rates just to get to a point where you can use conventional ammunition again in the future. But also, if the U.S. economy is firing on all cylinders and with unemployment below 4%, wage growth, wage inflation, commodity inflation, and they're moving to tightening financial conditions, that would indicate that the U.S. economy is very, very robust right now. By extension, the Canadian economy is probably running fairly hot as well. So it makes sense just from an economics policy standpoint that both would be hiking interest rates. Now, if you want to compare that to, say, the Japanese economy or to most of the Eurozone, you can see why they would lag and continue to be more accommodative, given that their economies aren't running as hot as ours is.
Dennis, we only have about 45 seconds or so until the next commercial break. How big of a headwind is inflation? There's still some belief that there's pockets that's transitory, but then wage inflation is definitely not.
Right. And let's keep in mind that up until last year, we hardly saw any wage inflation in the North American economy. So this is kind of revenge of the workers, if you will. They finally have the ability to demand wage concessions. And the most encouraging thing is that it's people with very light skill sets that still have the ability to negotiate greater income. And that's important because people who haven't completed high school or haven't completed university, historically, the North American economy has left them behind.
Okay.
So this chance they have now to actually secure wage increases is important.
Welcome back to Strictly Money. I'm here with Dennis Mitchell of Starlight Capital. Dennis, before the commercial break, we were talking about inflationary pressures, some of it being transitory, some of it not. I want to get your take on the supply disruptions that we're seeing as well, and whether that can work its way through.
Right. So the inflation that we're seeing now is very different from what, inflation that most of us studied in business school. Historically, inflation is created by an increase in demand. And so the way to combat that is to tamp down demand. What we're seeing right now is a lot of the inflation we're experiencing is driven by the supply bottlenecks that we're seeing. The COVID and the havoc that it's created in Asia, which is where a lot of global manufacturing is located, and then congestion at things like the Port of LA. And so you combat that type of inflation very differently in that it is by design transitory. At some point, you're going to relieve the bottlenecks. At some point, we're going to be through the pandemic, and those supply disruptions are going to fade away. So I think, a lot of people are expecting the Fed to respond to inflation by hiking interest rates 4 times this year. I think they may be disappointed because I think the Fed is going to be data driven and they're going to see the supply bottlenecks and disruptions fading away. And that will put less impetus in their need to hike interest rates to combat inflation.
Okay. I want to switch gears and I want to talk about real assets because this is where you particularly pay a lot of focus. Real assets meaning real estate as well as in infrastructure. Real estate is an interesting one, right? Because typically if you look at REITs, they do well in a declining interest rate environment, but you're seeing good opportunities in REITs. Walk us through that.
Right. And so real estate and infrastructure both do well in declining interest rate environments, but surprisingly, and again, we have to talk about which interest rates are going up or down. The environment we're going to see in 2022 is policy rates going up, the short end of the yield curve. Our own thesis is that the long end of the yield curve is going to be anchored at between, call it 170 where we are now and maybe 2.25 max. And so in that type of environment, real estate and infrastructure should actually perform very well. And if we dig into what is actually happening in these businesses, you can see why. So if I look at traditional businesses, about 60% of their operating costs are tied to wages. And so with the wage inflation that you've seen, and again, it's at all levels of the organization. Walmart's paying $15 an hour, Amazon's paying $18 an hour. If 60% of your operating costs are tied to wages and they're going up that fast, well, you can see how corporate margins are going to be squeezed. And then at the same time, global growth is slowing because policy rates are going up, right? And so what you're going to see for traditional diversified businesses is revenues plateauing or the growth rate of revenues coming down at the same time that their operating costs are increasing materially. And so margins are shrinking, earnings per share growth is shrinking. And so as a result, they underperform real assets. And if you look at what happens with real assets, if long bond yields are sort of locked into 170 to 225, then the cost of debt for real asset businesses is not going up nearly as much as the cost of labor is for traditional businesses. And then when you look at the essential nature of the services provided by real assets, shelter, communications, transportation, power, water, well, the demand for those services is actually going to increase as global economies reopen and we go back to normal. So you have a situation for real assets where their revenues are going to continue to grow where their operating costs aren't increasing nearly as much, you have margin expansion, cash flow growth, and the market will reward that with a higher multiple. And we should see real assets outperform traditional equities this year the same way we did in 2014.
So what pockets of REITs do you like? I'm assuming that office REITs, there's a lot of pressure there given this change in how we're working. What about, I don't know, retail REITs or other REITs where you see better opportunity?
Yeah, regardless of the business, whether it's real estate, infrastructure, shoe retailers, what you want are companies that are growing their cash flows, right? And you start from the top and work your way down. You want to see companies that have pricing power, companies that are growing the number of units that they're selling. You want to see control over their costs. So when I take that screen and I look at real estate in particular, we really like industrial and multi-residential real estate. Why? Because again, the demand for that real estate is increasing. Rents are going up. And so again, your price and your units are increasing. And so your revenue is going up. And we've already made the point that the largest cost for real estate companies is the cost of their debt. Yeah. And if that isn't going up materially, then you're going to see cash flow growth superior to traditional equities and superior to the REIT industry. The need for bricks and mortar retail is coming down. And the pandemic has simply just exacerbated that. Okay. So we're not gonna see all retail REITs disappear and all retail physical real estate disappear, but the need for as much square footage per capita is coming down.
Welcome back to Strictly Money. Dennis, let's talk about infrastructure, also an area that you look at very closely. What areas of infrastructure are you particularly favorable towards? Because it's a huge space, right? There's energy, there's transportation, there's communications. Walk us through that.
Yeah, and so at Starlight, we've taken a more comprehensive look at infrastructure. And so most of the time when you look at infrastructure funds, they're just in those three sectors: energy, utilities, and industrials, whereas our solutions encompass anywhere from up to 8 of the 11 underlying GIC sectors. And so what we like right now in infrastructure is you want to go where the money is headed. So billions, hundreds of billions of dollars have been allocated to renewable energy. That is the future of this planet, let alone North America. And so there are tremendous opportunities to grow renewable asset businesses around the world, whether it's solar or hydro or wind. And so those businesses have attracted a lot of capital. They are generating very strong returns, and we're happy to allocate capital there. Communications. More and more of telecom companies are offering unlimited data plans. And when you look at the data consumption differential from, say, sending a quick email to streaming a show on Netflix, you can see that increasingly the data utilization in this world is increasing. And we probably don't notice it as much in North America because we're already a data-centric economy. But if you start looking at where big population centers are, Brazil and China and India, they are just beginning their ramp in terms of data utilization. So companies like cell towers and data centers and fiber companies also provide essential infrastructure. And then lastly, we would say global trade accounts for a big chunk of global GDP now. It's a global economy, truly. Things that are manufactured in China make their way out to Boise, Idaho, So companies that contribute to the global logistics supply chain, whether it's cargo hauling or ports or processing. So those types of businesses are certainly in demand. It's a fantastic industry. And as global growth continues to grow, the demand for their services will continue. So those are three areas that we really like, that we've allocated significant capital to.
Dennis, when it comes to infrastructure, though, it is expensive to build, right, and maintain. So does that really matter?
Absolutely, because it creates an enormous barrier to entry for smaller players, and it makes it more of an oligopolistic industry globally. So, for instance, when you walk into a room and flick a light switch, you don't sit there and say, "Am I going to flip the hydro switch or the gas cogen switch?" Or no, you just flip the light switch. For a company to come in and compete with, in my case, Enbridge or Oakville Hydro to provide a competing electricity grid with an alternative source of energy, it's just not going to happen. So these huge businesses are incented to continue to expand their network coverage to provide efficient electricity water, gas, but they are regulated. And so the amount of returns they can generate as a result are capped. But these businesses find new and innovative ways to generate more returns and cash flow for investors.
You know, when you look at real assets, including infrastructure, there's different ways, obviously, to make money. Would you say this is more of an income play versus a capital appreciation? And the second part to that is, how would you compare this to blue chip dividend stocks?
Sure. Well, Saijal, there are three ways that any equity generates returns for an investor. There's cash flow, there is growth, and there's the multiple it trades at. And so we always say that real assets are a total return play. They are businesses that generate strong internal growth that funds rising dividends and distributions, and that encourages people to pay higher multiples for those stocks. Now, when we look at real assets in particular, empirical data shows us that companies that have historically grown their dividends have outperformed traditional equities in the market, and they've done so with less volatility. So when we look at real assets, whether it be REITs or utilities or what have you, they are historically businesses that investors have looked to for income, and they've paid higher than average dividend yields and distribution yields to investors. But that overlooks the fact that these companies also have significant growth potential. And so as a result, they have historically outperformed traditional equities on the back of their growth, their commitment to increasing their dividends, and the fact that those two result in investors paying higher multiples for them.
All right, Dennis, appreciate you coming on the show today.
Anytime, Saijal. Thanks again.
Dennis Mitchell, CEO and CIO at Starlight Capital. Once again, if you have thoughts, feedback, or questions about today's show, send us an email. Until then, stay well, stay wise, and stay wealthy. Thanks for watching.